Good afternoon, this is Bob Iaccino coming to you from the CME Group trading floor in Chicago, talking energy futures. Let's talk about crude oil, up almost 3% on the highs, just over 2.8% when it reached above $63 a barrel on the futures contract. That is the highest move since February 12th, when we reached exactly up 3% from close of the prior day to the open. It is the second biggest rally for the month of February, which again has been pretty much a rally month. Going in with its seasonality, the seasonality which I've talked about quite a bit, had crude oil falling in the beginning of February, first week to 10 days, and then rallying throughout the rest of the month, and really rallying through June. And that's kind of what we've seen so far as we get in toward the end of February. We had API data yesterday and EIA data this morning, pushed back a day on each because of the President's Day holiday here in the U.S., and both reported crude oil draws and gasoline builds, counter to what the market was expecting. The market was expecting builds in crude oil as well as builds in gasoline, but the crude oil draw spiked prices. We got a confirmation out of the EIA from the API report. API report showed a 907 barrel draw of crude oil versus about 1.4 expected build, and then the EIA number 1.6 million barrel draw versus an expected build of around 2 million barrels. Again, both builds in gasoline supplies, and the dynamic behind that really is refineries ramping up. We saw a 3% increase in refinery throughputs, which is really refinery utilization, up past that 95% level where they were prior to the hurricanes we saw in the end of the summer season. And those levels are consistent with refineries trying to stockpile gasoline, winter blend, so they can get ready to retool as the summer driving season comes on. And this narrative is going to be around for a little while. That's sort of why the seasonality comes into play, minus any other things like geopolitical risks or supply disruptions or things like that. So you still have inventories, or rather production in the U.S. building, but those draws are really driven at the refinery level. Also, demand expectations have been pumped up by both the IEA, the EIA, OPEC, all of pumped up demand expectations. But we also have the central banks adding a little bit of fuel to that fire, no pun intended, because both the ECB and the US FOMC both talked about much stronger economies and sustainability of that economic strength, especially with the US FOMC. So you could expect demand to meet those pumped up expectations or possibly even exceed it. We don't have much out of China because of the Lunar New Year that they're celebrating. So everything's kind of shut down and quiet from that end. But the demand expectations certainly add on to this. So again, crude oil jumping second largest for the month of February. That seasonality really taking over as we get up above $63 a barrel on the high, pulling back in toward the end of the day, but remaining above $62. This is Bob Iaccino talking crude oil futures from the CME Group trading floor in Chicago.